Welcome back, degenerates. This is Trades and Gains, the show where we don't trade vibes, but instead we trade footprints and actual money. Tomorrow, well, it's Christmas Eve. We have a short session. We're going to have baby shit thin liquidity. We're going to have wide spreads and institutions doing exactly what you'd expect, positioning early and quietly. But guess what? Today, the FlowScanner, it went ahead and lit up like Rockefeller Center on Christmas Eve. This episode, which is episode 3, we're going to go ahead and break down SPY, NVDA, QQQ, IWM, GLD, and Google. Now, this is going to be done through Investor Central Club and their FlowScanner tool, because price alone is lying to you right now. Let's go ahead and dive straight into it. So before we dive into the prints, let's talk about the macro backdrop. Here's the environment we're in. CPI, it is come and gone. The TIPS auction, it's done. Liquidity is drying up fast, and tomorrow is a half day of trading. Dealers don't want exposure overnight, and funds don't want surprises into the end of year. So what do? They hedge, they position selectively, they clean their books up, and they avoid those hero trades. This is risk management season, not YOLO season. And guess what? The FlowScanner confirmed it today with our top 6 prints. So first, let's kick things off with our big guy, SPY. We had 48.5 million in total premiums today, with 45.91 coming into puts and only 2.8 or 2.6 million in calls. This is not fear, this is portfolio insurance. Now, our biggest print of the day today, if we go ahead and click on that, we can see it was the 675 put for January 30th of 2026. We had a good amount of money dumped into this thing. We even had a big money print for it, 1.53 million dumped in at a 594 average. Now, again, this is not fear, this is portfolio insurance. This was a high frequency contract, and it was repeated positioning that we saw throughout today's session. The translation for normal humans, institutions right now are telling you, we're not bearish, but if liquidity disappears tomorrow, we're not going to be bag holders. That's classic holiday hedging behavior. If SPY holds, well, the hedges decay, and if SPY slips, then that protection is going to pay. It's kind of like getting fire insurance. You may never think you're going to be in a fire, but if you are, you sure are happy that you had that insurance. That's how professionals sleep at night and don't really have to worry about their portfolios. Next up, we have NVDA. NVDA, we had 37 million in total flow, 23.84 million going into calls against 13 million in puts. Our most traded contract of the day today were the 180 calls that are due for this week. This week, folks, we had almost at 10:35, between 10:30 and 10:35, we had 1, 2, 3 big money prints for almost $5 million. Yeah, this is what you call controlled optimism. This isn't NVIDIA to the moon, because mind you, NVIDIA is it is currently sitting at a price of $186.89. So what do we like to call this, folks? Delta hedging. Because it allows you to buy the stock, but without the exposure. That's what this is telling you. They want exposure, but they don't want reckless exposure where they have to go buy those shares. This is a consistent frequency contract. Again, and this is pre-holiday positioning for that delta hedge. Now, what are we learning from this? Well, institutions still believe in the AI leadership of NVIDIA, but they're sizing risk smaller. Again, that delta hedge, because what is the benefit of that? Well, the benefit is for every dollar that NVIDIA moves, you get $1 back on those contracts. So it's basically like getting to own the stock without having to own it. And this isn't FOMO, so don't go racing in thinking you need to get into these. This is just what we like to call measured conviction. Now, mind you, these contracts expire at the end of the week. NVDA still is going to remain best in class, even into thin tape at the end of the day, because that's where we can always see action happening. Our next ticker that we're going to review, we're looking at QQQ. This is tech exposure, but it's a little bit dialed back. QQQ is looking a little bit casino-ish, in my opinion, today. We had 16 million in total flow, with 9 million in calls against 7 million in puts. A lot like NVIDIA, this is a coin flip market. This is a coin flip market, you know? Or not NVIDIA, Tesla. It's a coin flip market. Funds want that tech exposure, but they don't want surprises into Christmas Eve, year-end, low liquidity. It's a difficult spot for them. So what do they do exactly? Well, they take balanced positioning. They take tight hedges. They look for short-term exposure. And QQQ Flow is screaming, we're involved, but we're nimble. Now, our most popular contract are the February 20th, 2026 $600 puts. And these were bought at the 621 spot, right? So these came in towards the end of the day. We had 4 hits. We had 4 hits on these. And despite the tape leaning bullish, we're still seeing these bearish bets kind of take the lead of our most, and one of them was a sweep. So it shows that dealers want to get in right now. That JG Wentworth flow, it's my money and I want it now. And guess what? If volatility spikes tomorrow, QQQ will be the first to feel it. I promise you that. Now, our next one is the redheaded stepchild of the group. It's the little orphan Annie, as I like to call it. The small caps getting clapped. IWM, we had 14.74 million in overall flow. 14.26 million of that was in puts, and 479K only in calls. Barely 480K. Come on, people. And the highest frequency on the board, we had 19 hits of the 240 puts due for January 16th of 2026. This is loud, very loud. And you want to know why? Because while institutions are still avoiding small caps, hedging growth risk, and they're not betting on a year-end miracle. Into low liquidity, they want quality and safety, not beta. And let's remember, folks, comment in the chat below, who benefits the most from rate cuts? It's IWM and small caps. Why? Because it allows them to get money cheaper, so when they look to grow and expand, it won't cost them as much. You're probably like, well, why does that? Well, you want to know why it matters? The companies in QQQ and in SPY can afford these 20-year bank highs. Trump just came out today and said if inflation doesn't get under control, we can always just hike rates. And we have an 85% confidence rating from CME Fed Watch that we will hold rates steady in our January meeting coming up. Now, IWM is going to remain the risk-off pressure valve, meaning we're going to see a lot of bearishness going into this thing end of year into that next Fed meeting in January. Now, our next big ticker, we got GLD. GLDBABY. So GLD, we saw 13.93 million in total flow, 11.86 million in calls against 2 million in puts. This is what you call macro insurance in something like this. Now, granted, our 2 most hit contracts still made up for about $7 million. $7 million. Only $14 out of the money, and only an expected plus 3.5% move, or 3.2% move. Nobody is screaming recession yet, but someone is whispering If rates wobble, if equities slip, if something breaks, don't worry, we're ready. GLD call flow before a holiday, that's capital preservation energy. And mind you, our most hit contract were big money prints. Now, smart money doesn't ring bells, they just bring protection, and they bring it quietly. Our final ticker that we'll be reviewing tonight is Google. Google, defensive tech. We had 13.03 million in total flow. We had 1.49 million in calls. But don't worry, we had over 11.5 million in puts. This isn't bearish, it's earnings plus regulatory risk management. Google is profitable right now, it is cash rich, but it's still exposed to headlines. I mean, look at this. 11 million dropped on the 320 puts due for 1/30 of 2026. 320 puts. Google is at 315. Again, delta hedging. Funds hedge when liquidity thins. That's something to think about here. Okay? So this is nothing dramatic. This is more disciplined because I think there's still a lot of upside with Google coming into play here. Now, you're probably sitting there wondering, what does this mean for your Christmas Eve? Well, here's the takeaway. Tomorrow's a half day. Liquidity is going to be thin. Institutions, well, they're already positioned. Expect some choppy price action, exaggerated moves potentially, faster reversals, and options reacting before price does, based on volume, okay? So those are the things we need to watch out for. This is not the day tomorrow to chase breakouts, yellow weekly options, or ignore the flow. This is the day to trade smaller, watch key levels, and respect the institutional footprint. Now, why does FlowScanner matter today? This is exactly, well, price shows you what happened. The flow shows you why it happened. If you want to spot hedging versus speculation, understand institutional intent, avoid getting chopped in thin markets, this is the tool pros are going to use. In real time, mind you. And I do this every day over on free Wi-Fi radio on our Twitch channel. So feel free to join me over there because I love talking to you guys and getting into positions as a community. Christmas is coming. The markets are thin, unlike your waistline, and information is going to be the edge at the end of the day. This is episode 3 of Trades and Gains FlowScanner, powered by Investor Central Club. If you want access to live FlowScanner, big money alerts, unusual options, institutional grade context, go ahead and check us out at investorcentralclub.com. Trade smart, trade small, and don't let Stana steal your P&L. I'll catch you in the next episode. Make sure you like, subscribe, comment down below. What is your favorite position you're in right now? What's something I should get into for 2026? And maybe we'll consider getting into it. I'll see you guys for episode 4 tomorrow. It should be a short and sweet one. And I hope you all have a Merry Christmas and enjoy that time with your families. Goodbye.